Good morning and Happy New Year. I'm Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is January 3rd, 2023, and I'm going to go over your three threes for the week. I'm going to go over our major asset classes, their performance for the last week of the year and the full year 2022. I'm also going to go over our three favorite on a long-term basis and also on a short-term basis, how we are positioned on both equities and bonds. And I'm going to go over our top three market movers for the week. So let's jump on in.
Okay, let's go over the performance of the major asset classes on a month and year-to-date basis. Santa Claus was very generous last week for Christmas, but he decided to skip Wall Street. 2022 ends with a rare December decline. As you can see from this chart, the US dollar even was down 2.5, or bonds were down 0.6 to 1.7. The S&P finished down 5.9, NASDAQ at down 8.7, and small caps were down 6.5. One of the only bright spots for the month was gold. It actually finished up 3.8 for the month. On year-to-date basis, we still only have the US dollar and commodities as our two positives. For the year, gold was so close, a little bit more, and it would have finished in the green. However, it just was basically flat to slightly down at 0.13. Bonds finished down 11 to 12.8, and the equities were anywhere from -14 all the way down to -33 for the NASDAQ, and Bitcoin, the laggard of the pack, at down 64%. All right, let's go over the top three asset classes on a long-term basis for January 3, 2023. We did have a change this week. We had gold jump utilities into the top three. So they joined dividend equities and T-bills, and utilities coming in at 4. So defense is still on the field and the primary driver of this market heading into 2023. If we go back just 1 year, we can see that commodities, dividend equities, and utilities, so still very defensive heading into the year, and it remained there all the way through the end. All right, let's go over the bonds on a short-term basis. For the year 2022, year-to-date performance, down 12.8. And if you remember, we go over this chart every week, and we've been in protect mode the majority of the time this year, protecting our clients' money and making sure that they didn't have negative numbers on their bonds. We did try to nibble a couple of times, the last one being in the middle of November, and we still are kind of holding on to that, the small gain of 1.5, but nonetheless, it is a gain heading into 2023. However, the Bloomberg Aggregate U.S. Bond Index was created in 1976, so for the past 45 years, we've only had 5 times where the aggregate bond index has been negative, with 2022 being the worst of all of those periods, down to 12.8%. All right, let's go over the equities on a short-term basis. The year-to-date performance for the S&P 500 came in at negative 19.4. So very difficult year for the S&P 500. And as you remember, if you've been following us, this is now the 4th time we've been in protect mode. And if you look at this graph here, you can see that we've made lower lows and lower highs each time. That is representative of a bear market. We've got to see this finally start to make a higher high before we can start to get excited about equities again. And we just went back into protect mode as it just hit our 0 mark again. So for the 4th time, we're back into protect mode on the S&P 500. All right, but let's go over, this is a chart of the worst years ever for the US stock market, provided by NYU. And this 2022 came in as the 7th worst year ever for the US stock market. And for the balanced portfolio, for those that are in a 50-50 or 60-40 type of portfolio, have a little bit of bonds, have a little bit of equities, well, this is the 3rd worst ever, and they're coining it the Great Inflation. So not a great year for equities and bonds for the majority of the people out there. Not for our clients, but for the majority of people out there. All right, let's go over the top 3 market movers for this week. On Wednesday, we have the ISM index for December and JOLTS for November. The ISM manufacturing index tracks the manufacturing sector, and it's projected to have fallen to 48.5 for December, down from 49 in November. On Thursday, we have the ADP employment and initial jobless claims for December. The claims are expected to have risen to 225 last week from 230 the week before. This level of continuous jobless claims is the highest since February. So we've got to keep an eye as they go from 225 to 230. Hopefully they're not going to continue, but that's something the Fed is going to be watching like a hawk. On Friday, we have the non-farm payrolls for December. This is the number 3, or probably the biggest market mover for the week. Last month, it came in at 263, which was higher than expected. Well, this month is projected to have declined back down to 210. So again, as you can see, that the non-farm payrolls have been declining since the beginning of this year. So again, what the Fed will be watching, and it could be a market mover on Friday. That's it for this week. Thank you for joining us. Our next update is Monday, January 9th. So as always, continue to like, subscribe, and follow us. And we shall see you next week. Have a great week trading.